Okay, let's get started on the income section of the income and expense statement. I think it's important that we break these sections down into their basic elements and then get in depth on each section so you understand exactly how it operates. Now, in this particular video, we're going to look at the three parts of this income section. Now, the first one is going to be obviously the income line, which is the top part of the income and expense statement. Next, we're going to look at income reducers. Now, you may be thinking to yourself, income reducers? Well, aren't expenses income reducers? Well, no, expenses have their own category. What we need to understand here is that within the income section, there are categories that go towards reducing the income that are not expenses. And it's important that you understand exactly what those are and why we need them in order to really get a better handle on the multifamily financial statement. And then finally, what we need to look at is the other income section. Now, obviously, you might think to yourself, okay, other income, that's easy. If it's not rental income, then it's other income. And you're absolutely right. But it's important that you understand that when we're looking at other income, there are two types of other income. There's what I call the good income and what I call the bad income. Now, you might think to yourself, wait a minute, income, if it puts cash in my pocket, isn't that just good income? How can there possibly be anything called bad income? And the fact is that the bad income are categories that we should not include in our analysis. Well, why shouldn't we include it? Well, the fact is because remember, what we're doing here is we're trying to calculate out the net operating income. And the way we calculate out the net operating income is to start with the income section and then subtract the expenses, and that's how you get the NOI. Now, if we include all income in the category, that's going to increase the net operating income, which increases the value of the property, which means we pay more for that property. But if there's income in this analysis that we should not include, that will help us by reducing the net operating income and thereby reducing the value of the property. Okay, so this is important that when we look at the other income section, we break it down between including the good income and excluding the bad income. Now, what we're trying to do here, and the whole purpose of this analysis, is to be able to understand what is going on that property just by looking at the financial statements. And you can do that if you understand how each category works. And that's exactly what we're going to handle in this particular video. We're going to analyze the income categories, and that's going to help us understand exactly how the property is being operated. Okay, so let's take a look at the first part, which is the top line, the gross potential income. All right, that is at the top of every income and expense statement. Now, how is the gross potential income calculated? Very simply. Here's how we do it. We take all the units of a particular type, we multiply it by the market rent, and we multiply it by 12 months. So let me clarify this for you. So we take all the units of a particular type. So that means if this particular property has 20 studios, 36 one-bedrooms, 42 bedrooms, 53 bedrooms, we're going to take 36 studios times whatever the market rent is for that particular property, and times the number of months, 12 months. Now, market rent, that doesn't mean the scheduled rent. That doesn't mean the rent that's on the lease. That means the market rent that in that particular property they will be able to achieve if they were renting their units at market rent. Okay? So that's how we calculate out the gross potential rent. Now, what this requires is that every unit, every month, has to pay their rent and not be delinquent or late for an entire year. Think about that for a second. Under what circumstances will that happen? Only in one place. Never, never land. It doesn't happen in any other type of property. All right, so in order for you to achieve the gross potential rent on a property, you have to have every single unit achieving market rents every single month for 12 months, no delinquencies, no lates, everyone pays, 100% occupancy. It doesn't happen. Okay? So, I will get back to this particular concept in just a moment, but let me just take you through this. What we do then on the financial statement is we see the gross potential rent. Let's say for example, in this particular case, it's $1 million. And then you follow your eye down to the gross collected rent. This is what each tenant actually paid over the last 12-month period. Not what was expected, not what was billed, but what actually hit the bank account for rent, not other income, just rent. So in this particular case, let's say that they only collected $800,000. Well, the gross potential is $1 million, but $800,000 is what ended up going in their bank accounts. So you might be thinking to yourself, okay, all right, the difference is $200,000, but why does that matter? Why do we care? If only $800,000 is in my bank account to pay bills, why do we even care about the $1 million? Well, the question you have to ask yourself, and this is how the accountants figure things out better than we do, is there's $200,000 missing on this property. That's the way you need to look at this. It isn't $800,000 in the bank, it's $200,000 that's missing. All right, now you might think to yourself, well, okay, but who cares? I just care about the $800,000 in the bank account. Why would I care that there's a gross potential rent that we can only collect in Neverland, and the difference between the gross collect and the gross schedule is $200,000? Who cares? Well, you know what? We do. And here's why. Because the income reducers that I'm about to take you through are what tell the story of how well the property is being run. Now, think about that for a second. According to the numbers, I should make $1 million on this property, but I only made $800,000. And there's $200,000 that, according to the accountants, is unaccounted for. Now, if I can figure out where that $200,000 should be, I might be able to manage my property differently and ultimately collect that $200,000. And here's how we break down the numbers, all right? Let's focus for a moment on that $200,000. Where are those numbers? Where is that missing money? Well, obviously the first place that money disappears is in the form of vacancy. All right. Now, what you need to understand is that there are two types of vacancy. There's physical and there's economic. Now, whenever you speak to a broker about the vacancy on a property, 99 times out of 100, when you ask him what the vacancy is in that property, he will give you a number. And that number is always the physical vacancy. He doesn't tell you what the economic vacancy is. And you might think to yourself, well, what's the difference between the two? Okay, think about it this way. This is the easiest way to describe the difference between the physical and the economic vacancy. Physical vacancy are when heads hit the beds. The economic vacancy is when the hands don't reach the wallet. So what that means is physical vacancy are people living in your units. Economic vacancy are people that are in your units, but they're not paying. Now, why do we need to make a distinction between the two different types of vacancy? Why does that matter in our management of the property? And the answer is because when you understand the difference between the physical and the economic, you know exactly what's going on that property. All right, so let me explain to you exactly what I mean. When we understand what the physical vacancy is on a property, that means that we know how the marketing is going on that property. We know how hard the management staff is working towards putting people into those units. If we know that the physical vacancy in that particular submarket for that property is 10%, and our physical vacancy is 20%, that means that our management staff is lazy. They are not working hard to get the additional 10% in the doors and heads on the beds. And so that's how we know that from a vacancy standpoint, whether this property is being run well or not. Now, the economic vacancy, what does that tell us about how the property is being managed? Well, if we're not collecting the money, it means essentially one of two things, or maybe both. First is that the people that we have put into these beds are deadbeats. And we did a lousy job analyzing their economic status, analyzing their lease when they came on board, and therefore we are now stuck with these bad tenants. Think about it for a second. If somebody moves from one apartment complex to the next, we can pick up the phone and call that previous resident and say, resident manager, and say, "Hey, is this person a good resident or a bad resident?" And they'll come back and say, "No, that guy hasn't paid us in 3 months." If we still lease to that person, that's going to cause an economic vacancy problem that we just don't even want to deal with. So that is one of the things that we learn when we understand what the economic vacancy is on a particular property. So what it can also mean, having a larger economic vacancy number, it can also mean is that our management staff is not doing the job they need to be doing. They're not getting out there every day and knocking on doors to collect rents. If the rent isn't collected by the first of the month, then the second of the month, our management staff should be out there knocking on doors. And when they do, you will be amazed at how good the economic vacancy number looks on the property. So that is why we're looking at income reducers. One of the biggest income reducers is physical and economic vacancy. When we understand what each number means on the physical and the economic side, we know what's going on that property from a management standpoint, okay? So another economic income reducer is what we call loss to lease, or an economic increaser, I guess is the way to describe it, would be the gain to lease. Okay, I'm just going to talk for a moment here about loss to lease because we're talking about income reducers. Loss to lease, let me explain something to you. If we had determined when calculating out the gross potential rent that the market rent on one of these units was $1,000 a month, and then we went to look at the gross scheduled rents, what we had leased these units out for, and we find out that we had leased them out for $900 a month, that means that there is a $100 per month loss to lease. That means we are losing $100 per month on each one of these units. That missing $100 needs to be accounted for somewhere. And where we account for it is in the loss to lease category. Now, what you might think to yourself is, okay, So what? We lose $100, but all I care about is the cash. Well, actually, when we're looking at this property to buy, what we want to take into consideration is exactly where that missing money is and where it should go and why we don't have our hands on it. So the way you need to look at this is, and I'm going to get myself discombobulated from my computer cord here. What you need to do is you need to look at these particular properties and understand on the loss to lease, how far off am I from the market? Because when you understand how far off you are from the market, then that's going to make a big decision in exactly understanding how the property is being managed. Think about it this way. If your loss to lease number is 3% or less, that means that the property is being run very efficiently. And that means that there's really no opportunity for you to increase the rents on this particular property. You're going to be pushing them every year, just as you should, along with the market. But there really isn't much room for, as we call it, a value play on this deal. Now, what happens if your loss to lease is between 3 and 10%? Well, that gives you an opportunity to see, like, geez, I got an opportunity to increase the rents here and make a little bit more money. And increasing, if you're 5% below the market, pushing that number maybe 2 to 3% per year, within 3 years, you could have all of your rents up to the market levels. And that's pretty good. That means in 3 years, your property will be running efficiently. You're not going to hit 5% in the first year, especially on a C-class property. C-class residents will move for a $25 rental increase. That is huge money to them. And if you go towards increasing the rent by $25 per month, they'll move on you to the guy across the street. I guarantee it. And I can guarantee it because I've seen it firsthand. Now, if the loss to lease is greater than 10%, you got a problem. You got a big problem. That property is not being run efficiently. That property is not being managed efficiently. And you come in there and you look at that loss to lease of 10%, you might think to yourself, oh man, huge value play. I'm able to get out there and increase the rents on this property, and man, this thing is going to look great. It is going to take you between 5 and 7 years of constantly pushing those rents to get them anywhere near that market rent. And if you're dealing, as I mentioned before, the C-class property, you got a problem because it takes a long time to get those rents up. So when you look at a property that's got a loss to lease of about 10%, that's a problem property. That property is not being run efficiently. And you're looking to take over that property, you're going to be taking over a property that is not being managed well. So you look at it initially as a newbie, as somebody that's new in this business, and you think, oh man, huge value play. Look what happens if I increase the rent. Whereas I look at that and I think to myself, you got to be kidding me. This property is going to take forever to turn around. I've got to evict everybody out of here that is paying the current below market rents and put all new people in. And if I do that, then I've got to turn all these units, and that's going to cost me money to do that as well. So as you can see, when you understand what the income reducer categories mean, it'll tell you what it's like to own and operate this property. And that's why it's important to know what these numbers mean. I'll tell you something, folks, and this is between you and me. I had this conversation with my accountant, my property accountant, and we talked about loss to lease. And I said, what does loss to lease mean? And he gave me the textbook answer of what loss to lease means. I said, you're right, absolutely. We are on the same page. That's what loss to lease means. I said, now what does it mean from a management standpoint? He goes, what do you mean? I said, well, no. I mean, what does it mean when the loss to lease is at that level? Well, it means the loss to lease is at that level. No. What does it mean to own and operate a property that has a loss to lease at that level? He couldn't give me an answer. He knows the numbers, but he doesn't know what it means to manage a property based upon those numbers. And that is what I want to instill in you on these videos. I want you to understand when you look at these numbers, this is what it means from an operational standpoint. And I'll tell you something else, a little caveat here. Don't believe anything a broker tells you that what I just said is different in any way, shape, manner, or form. What I'm telling you is the absolute truth. Stick with what I have to say. You will buy the property the right way. All right, now let's take a look at another type of income reducer, concessions. Now, what are concessions? Concessions are giveaways. We're going to concess our rent to you. We're going to concede our rent to you. In other words, if you drive down a street that you're looking to buy a property on, and you see that there are a bunch of apartment complexes on that street, and you see everybody has a sign out that says, first month free, that's a concession, and that's a lousy way to do business. It's a lousy way to do business, and here's why. You can find in those markets where there are first month free like concessions, you can find some residents who are professional concession shoppers. What that means is that you can have a guy sign up with you today, get the first month free, not pay the second month, you start eviction proceedings, it takes you another month to get him out, and at the end of the third month, he's moved on to the next first month free place. These are what I call professional concession shoppers. These are people that can go for an entire year without ever paying rent. And it's because of the way that the landlord has structured it with the first month free. Now, if you're going to do this, what you want to take into consideration is, hey, I'll make the second month free or the third month free, but conditional upon you making sure you pay the first and the second month on time. If you didn't pay the first and the second on time, you missed it by a day, you don't get the concession. That's one way of doing it. I don't like any of those. I used to think, man, if I need to lease up this place, I'm just going to offer first month free. Everybody's going to come in here. This is a great deal. I'll have the place leased up in no time. But you end up leasing them up with lousy residents. And those are your customers. You're running a business. And if you got lousy customers, you're going to have a lousy business. So think twice before you offer those types of concessions. Now, there's another type of concession that actually works out pretty well. And I'm just giving you two examples of concessions. I'm giving you two examples because these are, typically what you see out there. There are so many other types of concessions, but what I want you to understand is that when you see concessions on the income and expense statement, you've got to ask yourself, why? If the broker is trying to tell you that the occupancy on this property is 95%, and you look on the income and expense statement and there's a line for concessions, you've got to ask yourself, why? Why are we giving away money if our vacancy is only 5%? That doesn't make any sense. There's something wrong with the numbers in the categories that they're giving them to you. So you need to make sure that you understand this when you're looking at these numbers. The numbers tell the story. The categories tell the story. When you understand how the categories work, you'll know exactly what's going on. So when I look at a property that's at 95% occupied and I see a line item on the expense statement saying concessions, that's a red flag. That doesn't make any sense to me. Why are we doing that? So that's the thing you need to understand when you're looking at these particular numbers. Now, resident referral, I love that one. That one works great. Hey, if you refer somebody in here and they stay and they get approved and they move in, they sign a lease, we'll give you $200 off your rent next month. Now, that $200 needs to be accounted for. It's accounted for in the concessions section. Okay, but that's a great way to do it because you get somebody in that somebody else recommended, and it only costs you $200 of an in-kind transfer. I mean, $200 in this particular example is real cash, but you know something? You gotta pay money to make money, but that's an easy way to do it as opposed to a first month free. I hate first month free. Okay, now the other thing is I want you to do an internet search, and what I mean by that is. What I mean by that is that you go online, you do an internet search on the property that you're looking to buy. A lot of times, even on Craigslist, you can find, this is what happened to me one time. We did a search. We looked in the income and expense statement. There was nothing wrong with it. There were no concessions. And then we did an internet search and it popped up on Craigslist that these people were giving away a $200 per month concession. Okay. The income expense statement says there are no concessions. The internet says that they're giving away concessions. And you go back to them and say, hey, how many people have signed up for December 1st lease date? Oh, we had 12 people. And did they all get that $200 deal? Yeah, they did. You saw that? Yeah, we did. And we're just trying to figure out why it doesn't appear on the income and expense statement. Oh, that must be a mistake. Oh, you think? That's a big mistake. That's something that we need to fix. So these are the types of things you need to be a detective when figuring out these types of issues, because they all tell this story about how the property is being run, and you need to know these stories. Okay, so here, the next section we want to talk about are managers' units or office units. Okay, now just think about this for a second. You're looking to buy a 150-unit apartment complex. One of the units is the office. It's not a separate building. It's one of the units. Well, how many units can you really rent out in a particular year? 150 or 149? You can rent out 149. You can't rent out that 150 because that one will always be the office. It will never be a unit. So we've got to account for that one unit somehow. And that's how we do it. It goes towards reducing the income. Other types of things that go towards reducing the income are down units or storage units, which are essentially apartments that they're using for storage, which is the stupidest thing I've ever seen. I mean, if you can walk down the street to Bob's, you store it for $60 a month versus renting out that unit for $800, you're an idiot. But I've seen it happen, believe me. So you need to understand when you're going through these particular this analysis is how many units are taken out of the analysis, because that takes us from the gross potential rent down to the gross scheduled rent. And we need to account for that. In the example we gave earlier, the $200,000, we need to account for that $200,000. Where's all that money going? And once we understand where all that money is going, we will know how to manage the property to mitigate those numbers as best we possibly can. Okay, so that is the extent, or there's always some other things that they need to add. Every unit is different, every property is different, but that should give you an idea of how we go from the gross potential rent down to the gross collected rent. And remember the word rent here. We're not talking gross collected income. We're talking about gross collected rent. And the difference between those two numbers are what we call income reducers. And when you understand the categories of those income reducers, then you will know that how that property is being run. And that is key. Now, that's the first part of the income section. The next part and the final part of the income section has to do with other income. Now remember what I said before. There are two types of other income. There's the good income and the bad income. All right? Now what we want to talk about and how I want to break these things down into the good income and the bad income so that you can get a better understanding is exactly how it works. So for this particular case, let's talk strictly about good income. Now we may get into some philosophical differences between what's good and what's bad or what have you, but let's just try to keep this on on a level playing field as we go through these different types of income sections. Okay, now, laundry income, laundry fee income. Good income or bad income? That's good income. You can see this money coming in every month. You can see it being used every month. Everybody has to wash their clothes every month. And so that's why laundry fee income is good. Now, let me give you some rules of thumb on laundry fee income. Now, the thing with laundry is that you can either own the washer dryers yourself, or you can outsource them to a company like CoinMock or Jets. And these are people who come in and will give you a laundry contract. Now, I'm not going to talk to you here about the initial application fee that they give you, the enrollment fee. It's pretty nice. It's when you sign one of these contracts, they'll write you a big check. But what I want to talk to you about is how the split is with these particular third-party laundry companies. So if you own the units yourself, that means you're responsible for maintaining them all. If you outsource it to another vendor, they handle everything. They come in there once a month, they clean out the coins, and they send you a check. Very nice. Because you're not in the business of maintaining washer dryers. You're in the business of running a property. So if you can have some other company come in there and do that for 50-50 split, that's pretty good. And they all write you a big fat check when they sign the contract. It's really nice. So the rules of thumb are, if you own the property, own the units yourself, your income on this particular section should be about $20 per unit per year. Now, if you split this with a third-party company, second-party company, you should receive about $10 per unit per year, or $10 per unit per month income. All right. So that means that when you look at the income and expense statement from what the company is offering you or telling you that they've earned the laundry fee income, make sure the numbers look like that. Okay. Now, if you see a property that has all the units have washer dryer hookups, don't expect to see anything on the income section. Those people are going to bring their own units to the unit, their own washer dryer machines to the units, and then you're not going to make a dime. All right, so just keep that in mind when you look at laundry fee income. If it's a washer dryer hookup, you're not going to make a dime. Just FYI. All right, now utility reimbursement income. Now, this is the income section. I'm going to talk about the utility fees on the expense section. But right now, all I'm talking about is the utility reimbursement income, all right? There are different ways that this can be calculated. You can either set the company up on a RUBS system, which is an acronym for Ratio Utility Billback System, where this is a company that will actually come in and calculate what each unit owes in utility expenses. Or you can set it up on a flat fee amount like I do in some of my properties for the water, where everybody has to pay a $25 water fee. All right, so utility reimbursement income, the thing that you always want to do when you're looking at an income and expense statement when it relates to the utility income section is you look at the utility income section, and then you take your finger and you draw it all the way down to the expense section for the utilities. And you compare the two. You look to see how much am I taking in an income and how much am I spending out in expense, and what's the difference between the two. Let me tell you something, folks. I've never seen a utility reimbursement income exceed the expenses for utilities. It's not designed to do that. So if you are looking to make money on your utilities, it won't happen. What you are doing with the utility reimbursement income section is we're mitigating the damages. We're mitigating that expense by receiving some income. Now, here's what I typically see with some of these properties. They will come out with some great, grandiose, bold statement that we've converted, everyone is being converted to utility bill back, and within the next 12 months, everybody will be on this, and so our expenses will be lower. Really? And how many people are going to move out because they can't afford this utility bill back? And how many people you're going to have to go back and turn their units? And you're going to have to lose a couple of months of income while you replace their units. And so when you see somebody that says we are in the process of implementing this new change, you don't want to be the guy who has to eat those missing months. Trust me, you will lose 100% of the time. All right, so that's the utility reimbursement. Now let's take a look at this application fee income. Now this is very important. It is so important. I've got to stress this to you. Let me explain to you what I mean by application fee income. Actually, let me clarify here. I jumped ahead of the game. I actually wanted to clarify administration fee income, but this is application fee income. Allow me this little do-over. This is coming to you uncensored and unedited. So let me talk to you about application fee. Application fee income is not necessarily great income. It's not bad income, but I want you to look at it in a particular light. Application fee income means that people are walking through your doors and applying for a unit. And every time they apply for a unit, they pay down some money, typically $25. Now, if you're looking to fill up your place, you might want to waive the application fee and have people just come and apply. But typically what you do is collect maybe $25 for the application fee. So when you see a property that has an application fee, what you do is you go in there and divide the numbers by 25. And that should give you an idea as to exactly how the property is being, how much activity there is on that particular property. And when there is you look at it and you think, okay, if I take that number and divide it by 12, how many new applicants per month am I receiving on this property? And that'll give you an idea as to exactly how busy the leasing manager or the property manager is in leasing up that unit. All right, so you want to use this application fee income category to give you a handle on exactly how active the property is. Now, from an income standpoint, it isn't really great income because this is one of those types of incomes that actually has a corresponding expense to it as well. Now, when you take in $25, you typically got to pay out about $18 in a credit check and a criminal background check. So that means you're only really netting $7 per application. So is this really good income? Well, it's good income in the context that you get to understand how much activity is going on that particular property. All right? Now let's take a look at month-to-month premium. Now you might think to yourself, okay, well, is this good income or bad income? Okay, well, it's good income because what this is doing is if the rent is $800 and a person doesn't want to sign a year lease, you don't charge them $800, you charge them $850 because they're like essentially breaking the rules and you're allowing them to break the rules. But the way that you're allowing them to break the rules is they're going to pay a little bit more. And so instead of putting that on the books as an $850 rental income, what you're doing is you're saying it's $800 and $50 of it is on a month-to-month premium. Now, why is this important from a category standpoint? And the reason why it's important is because now you're able to go back and say, okay, how many people on this property have not signed year leases? Whoa, 50% of the people are not signing year leases. I'm making all this extra month-to-month premium, MTM premium, but I don't have the security of knowing that these people are locked into a 12-month lease. And that might be a concern. And it might really be a concern with the lender if he only likes to see units that are leased out on a 12-month basis. So you got to think about this when you see the month-to-month. You got to think to yourself, first off, why aren't they signing the leases? How many of them are there? And am I going to have a problem with the lender because of it? So that's why month-to-month is good because you get make more money. But seeing this category up there, you've got to monitor it and make sure that it is not too far down the road. That's the biggest concern. Now, pet deposits and pet fees. Good income, bad income. I think it's good income. People love their pets. They keep them around. And typically what happens is you've got pet deposits and pet fees. Now remember, with security deposits, you got to give it back. But the way we structure most of our pet deposits is that we get to keep it. That's money that goes into our pocket. All right? And then the pet fees, it's like the month-to-month premium. We charge them $800 a month, but oh, you have a pet, we're going to charge an extra $25. So their rent is $825 a month, but the $25 is categorized differently. And that way we can understand how many people are actually in that pet fee arena. And that's the key here. You want to understand the difference between the two, all right? So on the pet fees and the pet deposits, that's how that works. The thing you need to keep in mind, we're going to talk about this more in a second when I get up to the administration fee, is that the pet deposits are in the pocket of the existing owner. When you take over that property, unless you have structured it in the LOI or in the purchase and sale agreement, those pet deposits, when the person comes on board, goes into the pocket of the existing owner. That's something you want to keep in mind when you're making your offer. So when you look at the income and you see, oh man, they made $10,000 in pet deposits last year. That's money's gone. You're never going to see that. Why would you include that number in the other income category and then capitalize it? You're going to end up paying for something that you'll never receive. You've overpaid for the property. Now, I'm including it here in the other income, good income section, because you know what? The pet fees are fine, but you need to understand how the pet deposits work. Make sure you ask that question when you go live with the owner of the property. All right. Okay. Next, vending income. We should know what this means. You've got vending machines in the property, and they can pull money off of it. Go ahead and pull it. Now, here's the problem. This money is the most poorly accounted for dollars in the entire property. I one time went around with a property owner, and when we came up to one of the vending machines, she says, I haven't been here in a while. She whips out her keys, unlocks the vending machine, pulls out the biggest wad of ones, and sticks them in her bra. Like, we're going to account for that? Yeah. Of course. I'm going to report that. How much you want to bet that money ended up in her pocket? There is no accounting for it. None whatsoever. Laundry income, we got a third party that reports to us how much we earned. Vending machine income, especially if we own the vending machines, nothing. Okay? So that's what you need to understand when you're going through this. It's very, very important that you realize some of this is good income, some of it's bad income. You just want to make sure that you're online. Now, cable and cell phone. Yeah, you get a cell phone tower on your property, manna from heaven. There's so much income off of those units. That's great income. I had one guy that he was looking to sell his property. Cell phone company came up and said, hey, can we put a tower in your property? And he goes, yeah, go ahead. What the heck? Puts a tower in the property. The guy stopped selling his property. He makes more money from the cell phone tower than he ever did renting out the building. That's what can happen with some of these towers. All right, so when you see cable fee or a cell phone income fee, that's good money. That's very, very good money. Stick with it. Now, let's talk bad income. Let's talk those income categories that you should not include in your analysis, that you should not capitalize and pay the owner for. Now, just understand this for a second here, folks. You look at the property and you look at the different types of good income and the different types of bad income, and you look at one particular type of bad income. And what the owner is trying to do is get that bad income included in the net operating income numbers so that he can then apply a 10% cap rate on it and make 10 times its worth. And your job is to look at that other income section, say, hey, you know what? This is bad income. This is non-recurring income that I don't want to pay you 10 times value for. So therefore, I'm going to exclude it from my analysis. Now, what do I mean by different types of bad income? All right, transfer fees. Good income or bad income? Bad income. Transfer fees are what a resident pays you when they say they don't like their unit and they want to move to another unit. Well, they're current on their rent and everything's running fine, but we're going to charge you. We've got to go clean that unit. And we're going to get it back ready to up on that thing. We weren't planning on doing that for another 6 months or 12 months. But you were willing to do that because you like that other unit so much better? Great, you're going to owe us $300. The guy pays the $300. But that $300 goes into the other income category. Now, is that good income or bad income? Are you going to see that income again next year? No, you're not. The guy's moved. He may never, ever see another transfer fee income again. But they're asking you to capitalize that number and overpay for the property. Don't do it. All right? Security deposit forfeiture income. Good income or bad income? Terrible income. Terrible income. Remember, we talked about in the income section about the vacancy or economic vacancy, about how good we are or how good the management company is at choosing new tenants. Well, if you've got a lot of security deposit forfeiture income, that means your tenants are breaking the rents and moving out. And they don't even care about recovering their security deposit. They just want out of that place. That is a huge red flag, and that's something you need to take into consideration when you're looking at the other income section. Would you include that in your analysis for the capitalization? I wouldn't. That's bad income. Don't include it. Okay, next, NSF fees. Do I need to say more? Bounce check fees. Good income, bad income, bad income. But we have to account for it, but we don't have to capitalize it. Okay? Another is administration fees. Okay, folks, you need to understand this. This is crucial. Listen to what I am about to teach you and make sure that you never have it happen to you. You have two choices. A owner has two choices, actually three, when they take on a new resident. They can charge the resident a security deposit. They can charge the resident an administration fee, or they don't have to charge the resident anything at all. And that's a marketing decision. With a security deposit, that means that the resident is going to walk in and write you a check for $500. It is your responsibility to take that $500 and put it in a segregated account, depending upon the state law. If you go to sell that property, you have to account for that $500 and transfer it to the new owner. And if that resident moves out afterwards and leaves the place trashed, that new owner has a $500 security deposit in order to cover their losses, cover the damages. That's typically the way it should work. There are some owners that will play this other game with what are called administration fees. So understand the scenario I just gave you. Listen to this scenario. What they will do is when someone comes in and applies for a unit, they'll say, I need a $500 administration fee. And the resident writes them a check for $500. They do not provide a security deposit. They provide an administration fee. And what that means is that when that $500 goes on the profit and loss statement, the income and expense statement, as income. And when that resident moves out and trashes the place, what does the owner have to cover those losses? Nothing. There's no security deposit. So if during the time that the person has lived there, you buy the property from the existing owner, and then that resident moves out because he hates the place and he's trashed it, How much money do you have? How much money did you collect at closing in order to cover your losses? Zero. You have nothing. That means that the old owner took that $500, put it in his pocket, and said, sayonara. And not only that, it gets worse. Not only did he take that money and put it in his pocket and never has to disclose it or never has to account for it because it's income to him, when you go to buy the property, that $500 doesn't get transferred to you. Not only does it not get transferred to you, but if you included this income in your analysis, you have just capitalized that income, and you're paying, if it's a 10 cap, you're paying 10 times that administration fee over and above for that property. You've overpaid for the property because of calculating this bad income. Look out for this. I saw this happen all the time in Texas. All the time in Texas. It is a scam. Do not fall for it. And if you're thinking to yourself right now, well, Charlie, what do I do? You exclude it from your analysis. Well, then the broker is going to say that I miscalculated the numbers. No, you didn't. Trust me. They miscalculated the numbers. They're trying to screw you. Don't let it happen. When you see this type of game being played, and it is such a game, don't fall for it. All right? If you have any questions about that, folks, send me an email at info@multifamilyinvestingacademy.com. I'll be more than happy to walk you through it. If you have to put down your cell phone number and I'll give you a call. All right. Late fees. Good income, bad income. Bad income. It means the property's not being managed well. It means the little old lady's not going around knocking on doors collecting rents. It means she's letting people get very, very behind in their income, in their expenses, or their rents. That's not good income. But when you see it on here, it should give you an idea as to, well, this is telling us how bad the deadbeat tenants are. So that's why it's a good number to analyze, but it's not good income. Don't do it. All right, and finally, and this is the last section on the income section, the bad debt income. Bad debt. Bad debt is money that you will never collect. That's money that the people, well, I say will never collect. Obviously, if it's showing up as income, it's collectible. But typically, if you're dealing with a C-class residency, you're never going to collect bad debt. They don't care about their credit. They're moving on. You'll never see that money. But if you're dealing with an A-class or an upper B-class property, and these people want to keep their credit records clean because they're going to buy a house, so they pay their bad debts. And that's the only times I've ever seen bad debt income received is when we're dealing with a high-quality property. So if you see bad debt income on that particular spreadsheet, hey, okay, maybe this is a nice A, upper B-class property. And that's how you know. So that is the end of the section on income. So now you should have a very good handle as to why we look at the income categories the way we do. Not so much the numbers, but more what the numbers mean within those categories. That way we have a phenomenal understanding of exactly how the property is being owned and operated. All right? Stay tuned. We're going to take a walk through another long walk through the expense section. This is obviously the understanding financial statements is so important. I'm taking our time going through it. It's going to take you all month to understand it. But when you're done, we're making offers. All right, we'll see you on the other side.